What Greece has been doing essentially, or has had to do to reestablish competitiveness, is domestic deflation, right? And what we're seeing are the devastating effects of that, with record unemployment, poverty, especially among pensioners and others, in a way that I don't think we expected to see in Europe anymore in the 21st century, right? And so you want to have a conversation about how to reestablish competitiveness, get exports going again, get domestic investment going. But in many respects, unlike some of the other peripheral countries that are beginning to get traction again, in the Greek case, it's still very much about averting catastrophe. Is the bigger questions. Is Greece going to remain in the Eurozone? Is it going to honor its financial obligations to outside investors? And so, in many respects, you got to get some of those macro questions right before you can actually speak in more detail about reestablishing competitiveness. Ultimately, you're going to get that competitiveness through new investments, domestic investments, international investments. But my colleague Bob Schiller actually, I think, was on CNN earlier today, and he said, Greek stocks are incredibly undervalued and a great opportunity to invest. But he added a caveat, an important one, which is if Greece remains in the Eurozone and ultimately in the European Union and recovers, then it's a terrific buy opportunity. But in the Greek case, you still have the alternative scenario, which is, things could fall apart and Greece could very much end outside. And some on the left think that these are sort of, Wall Street sponsored horror scenarios, but I do very much agree with people who say there's a possibility that could mean, a generation of perhaps not poverty, but certainly something very different from what we expect to be the standard of living in the European Union. So, Greece needs to answer that fundamental question. European partners have to engage with it and figure out a way to make the adjustment process politically sustainable, but that adjustment process has to happen to reestablish some kind of confidence so investment goes back in, and at some point, slowly but steadily, growth resumes. So the Syriza victory is potentially, the most important development in this, third or fourth, however you want to put it, phase of the Euro crisis. I think the first effect, and we've seen it very clearly already, in the first couple of days after the election, already leading up to the election, is really a very intense debate about austerity. That debate has been going on, but despite economists questioning the wisdom of the German government's orthodoxy and sort of imposing austerity on everybody, governments at the periphery, generally speaking, have been playing along, right? I mean, they may have grumbled about this particular measure or that particular dictate, but if you look at what Portugal, Spain, Ireland in particular have done, they've essentially accepted to sort of take the bad medicine, right? Greece is different. They're now overtly challenging austerity, even to the point where they're essentially threatening to renege on promises, and included in that is to potentially not honor debt obligations. So that's a very real challenge, and it's going to force the other European countries, particularly Germany, to think about how they want to play this game. On the one hand side, you can make a case that Greece's debt burden is unsustainable, and if you want to help the country get back on its feet again, you have to lower that burden. On the other hand, there's a lot of indicators that suggest that Greece's the impact of Greek debt on sort of the day-to-day operations of the government actually are a lot lower than some of the other countries. Maturities are longer, interest rates are lower, and Greece has already gotten reductions in its debt that some of the other peripheral countries haven't gotten. Be that as it may, that's the first and most immediate impact, that it could really change the conversation around austerity. And of course, the German government is going to be very much aware of the fact that if they strike a deal with Greece, the others are going to be next. The Irish have been carrying a debt burden that is comparable, and they haven't complained, and growth has resumed. Of course, they would raise their hand and say, well, why do we not get a cut on our debt? And Portugal and Spain are in similar situations. So that's the challenge as far as European policy is concerned. Now, as far as the euro itself is concerned, I think most analysts believe that the contagion threats of a potential Greek exit are sort of domino effect threats are significantly less than they were, say, 2 years ago. European banks are a lot less exposed to Greek debt. Most of that debt is held by the European Central Bank, by member state central banks, member state governments. So there's less concern that a Greek exit could have implications similar to the Lehman default here in the United States in 2008, where it just sets off, a panic in the market. So the real challenge of a potential Greek exit is really how it would undermine whatever remains in terms of legitimacy of the European, monetary project. The fact that a country could not be held in, that it was essentially forced out, and this has never happened before in the history of the European Union. And there's a very real possibility that if Greece were to leave the euro, it would end up having to leave the European Union as a whole. And it's not like the legitimacy and public support of the European project is such that people would just shrug that off and move on. You have a lot of anti-EU sentiment in the UK, with the upcoming elections, the pretty strong Eurosceptic bloc in the European Parliament, and in many respects, losing, in quotation marks, Greece would further reinforce those forces who are really calling into question the viability of the European project. All of that suggests, as is always the case in Europe, that at the end of the day, the decision over how to engage with the new Greek government is going to be a political decision and not an economic decision. I think the economic risk is as I said before, less severe than it used to be, but the political risk of a potential Greek exit or the ramifications of it remains very severe and largely unpredictable. And so in the end, I think the politics are going to dictate the economics or trump the economics, and I do think, despite German insistence to the contrary, that some kind of a deal will be struck, and the real challenge is going to be how to ring fence it and how to make sure that it doesn't then lead to all the other peripheral countries asking for renegotiations, and that as a result the pressure on them to enact structural reforms is going to be diminished, which ultimately means that perhaps an opportunity is lost to really get to the heart of some of the issues that contributed to that lack of competitiveness at the periphery. We often talk about the periphery, we talk about the south of Europe, but we have to remember that the challenges in different European countries are different. The challenges in Spain are different from the challenges in Italy. Spain used to run a budget surplus until a couple of years ago. Italy has been racking up debt consistently for 20 years. In Italy, you have very competitive parts of the country, and other parts of the country that aren't competitive at all. In France, you have a problem, multiple problems. One of them is, governments changing direction. At one point you create, you enact reforms that are business friendly, and on the other hand, you go back to the 35-hour work week. In the Spanish case, in my view, one of the biggest challenges is the multiplicity of administration. You have essentially a ballooning public sector, which despite layoffs continues to be very large by European standards and creates tons of bureaucracy. Everything happens at the national level, at the regional level, at the city level. So to say that there is one set of reforms like the Agenda 2010, I think is probably misguided. But there are a couple of things that I think could happen Europe-wide that would help reignite growth and ultimately benefit all of those countries, in addition to the very specific reforms that each of them should be undertaking. What are those opportunities? The first one clearly is, and as a German who's been observing this from outside of Germany for a long time, it's sort of maddening that people don't seem to understand that not everybody can save at the same time. Somebody has to buy. And so we're talking about reestablishing, reigniting growth at the periphery. It's not going to come from domestic demand. The Spaniards, the Italians, the Portuguese, the Greeks, the Irish, they're still delevering. They're not going to spend. So who's going to, where's the market? The market is export markets. Well, export markets for those countries primarily means the rest of the European Union. And that means that, Germany, the UK, the Scandinavian countries, some of the others actually have to buy those goods. So clearly we need more demand, more domestic demand in those countries. The second one is overseas opportunities. The free trade area, the Atlantic Free Trade Project is incredibly important in that respect. I mean, I understand that we have concerns about this agricultural product and how do we protect that particular cheese, but tax-free access to the U.S. market would be incredibly beneficial to producers in many of those countries at the periphery who have been switching from serving domestic markets to overseas markets in Asia and Latin America and elsewhere. But the U.S. market continues to be the biggest and most dynamic in the world, and it also happens to be, of the developed economies, the ones that is growing the fastest right now, 5% last quarter. So getting that down would be incredibly important. Europe has to tackle education as an issue. The Bologna process was well intended, but hasn't really resulted in a more competitive, more how do you say that, globally competitive education sector. You can add to that challenges at the sort of primary and secondary level. Now, these are not going to be immediate measures, but at the end of the day, Europe has a lot of opportunity to learn from some of the best examples within Europe. How do we learn from Finland? How do we learn from the Netherlands and other places and reform our education systems? And then, the other one that keeps coming back, infrastructure. We're talking about tackling major challenges when it comes to the environment, to energy, to sustainability. A lot of that is going to be a lot easier if we actually integrate grids, if we complete some of those projects. There's still a lot that can be done to improve the infrastructure in Europe. I mean, the roads and bridges in Germany are crumbling, and Spanish infrastructure and construction companies are among the best in the world. So if you're concerned about Germany's competitiveness and you're concerned about jobs in Spain, invest in German roads and have Spanish companies fix them. Those things can happen. They can yield jobs, they can yield growth, and they cut across the board. But I do think that in each member state, there are issues that have to be tackled, and for some of those issues, left-wing governments might be better positioned if they can strike a deal with the unions. In other countries, right-wing governments may be better positioned because they can actually get employers on board, or they can get regional interests on board. So each case in that respect, I think, remains different. The issue of entrepreneurship, of course, has been on the agenda for a long time. I mean, 15 years ago, during the height of the dot-com boom, there was, Europeans were convinced that they were going to now have an entrepreneurial wave comparable to that of the United States. The Lisbon agenda was all about making Europe the most competitive economy in the world. I believe it was by 2010 or something like that. And of course, it's failed miserably in that respect. In many respects, Europe is less attractive for entrepreneurs now than it was, 10 or 15 years ago. There are some exceptions, there are pockets of entrepreneurship, but I think what we still haven't learned in Europe is that the whole idea of entrepreneurship is bottom up, and you can't create sort of top-down incentives or framework conditions for entrepreneurship. The European notion of fostering entrepreneurship is the government sets up a fund and starts investing. That's not what you're supposed to do. The Israeli example was the government sets up a fund and matches private investment. So the venture capitalists decide what to invest in, but the government actually co-finances everything they do without a word without a seat at the table and without actually weighing in on some of those things. So we're talking about fostering entrepreneurship in Europe. It's really at the very basic level. It's about bankruptcy code. For people to have a chance to write off their debt. Not much has changed in Europe in that respect. The costs of failure, the long-term costs of failure, are still way too high, which means that people shy away from taking some of those risks. Access to risk capital is still limited. Yes, there are government programs, but again, the government isn't particularly good at picking winners and losers. Then we get, Europe's Google, Europe's GPS. We don't need that. There's Google and there's GPS. Let's actually invest in things that customers around the world would need, rather than trying to compete with American products that have a 3 or 5 year advantage on that. And I think it happens in part when government programs allocate funds. So you want to create funds that private investors can tap into. Educational institutions play an incredibly important role. How can we actually create conditions where universities can set up entrepreneurship programs, create incubator space for students coming out of college, coming out of graduate schools to launch their own businesses? This isn't the kind of thing where you just sort of toggle a switch and then 2 years later you have the next Alibaba or the next Google or the next Facebook. This is really about systematically changing bankruptcy law, cultivating the development of the venture capital industry by providing them with some matching funding, by having tax rules that incentivize that kind of investment, and then really creating opportunities in universities, in communities, where people can come together around a project. So, there are things that government can do, but if government feels that they can fix the problem, chances are they'll be contributing to perpetuating the problem, and I think that's really what's been happening, generally speaking, in Europe over the past 10 or 15 years. Now, it's important to remember that there are very successful ventures that come out of Europe. There are entrepreneurs who choose to build their businesses in Europe. Spain now has an interesting program to attract entrepreneurs, modeled on a program that Chile had before, giving them temporary residence, giving them some funding. Companies have been getting better at setting up corporate incubators and supporting entrepreneurial projects. It falls way short of what is happening in the US, for example, because many of the sort of broader framework conditions are still not right.